Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Welcome to the show today as we take a look at the pros and cons of ESG investing. Let's get right to it. You know, in today's world, a company's bottom line doesn't always mean its profit or loss for the year. Increasingly, investors are demanding that companies measure and improve their environmental and social impact along with their financial performance. Triple bottom line investors care about people, the planet, and profits. If you're interested in doing well by doing good, you might want to consider ESG investing. ESG investors aim to invest based on environmental, social, and governance factors along with profitability concerns. And as of 2018, more than $22 trillion in investor money was invested in ESG-branded investments. Moving towards ESG investing might be the right move for you, but you should consider the pros and cons before diving right in. First up, the pros of ESG investing. Invest for the future you want. Investing in environmentally and socially conscious companies isn't merely about avoiding harm. Publicly traded ESG companies have the scale and resources that can allow them to create a pro-social future. These companies may positively influence the international corporate scene, or they may produce products and services that ultimately positively serve humanity. Investing in ESG funds gives you the ability to invest in the future you want to see. You can build a portfolio that will keep you invested in tough times. Overtrading tends to be hazardous to wealth. Many investing thought leaders have cited a study that Fidelity's best investors are dead because they can't overtrade. The study appears to be apocryphal, but its point remains. Common investors do best when they buy and hold over the long run. But sticking with a portfolio allocation can be kind of tough. Investors use all kinds of heuristics to avoid eroding their wealth through common mistakes. Some never look at their portfolio. Others dedicate a small portion of their money to Vegas money. And ESG investors can add another heuristic to help them stay invested, though. If you believe that your portfolio is bringing positive social effects, you may be more likely to stay invested in the long run. You won't have as much incentive to chase the hot new stock because it needs to fit into your socially curated portfolio. ESG investing may produce returns on par with traditional investing. Investors may worry that ESG investing will produce suboptimal outcomes, but there is evidence that ESG investing may be as profitable as passive investing. According to a 2019 white paper by the Morgan Stanley Institute for Sustainable Investing, a comparison of 11,000 funds, including several hundred ESG funds, showed no financial disadvantage of investing in ESG funds. The paper accounted for returns net of fees, which means that expenses were taken out of total returns. The paper not only analyzed total returns, but volatility as well. Of course, past performance doesn't guarantee future results, and over and underperformance may fluctuate depending on the economic cycle. For example, many ESG companies may underperform during energy stock booms. However, you may be able to weather these storms and see strong performance in your ESG portfolio. Cons of ESG investing. You may pay a greenium. Fees and expenses are the enemies of performance returns, and ESG funds tend to carry higher than average expense ratios. According to Morningstar's 2020 U.S. Fund Fee Study, this greenium may lead to some underperformance, especially compared to the very low expenses that index fund investors have to pay. Of course, you may be happy to pay a premium to a fund manager who actively researches ESG factors to keep the fund on track with your values. You have to pick your issues. No company can lead across every ESG dimension. Some promote women in leadership positions, others reduce pollution and carbon emissions. Others avoid cronyism and other misbehaviors that threaten democratic ideals at home and abroad. Few companies do everything well. And most companies choose to report their most impressive records. Even if clear metrics for ESG efforts existed, which they don't, investors would still have to choose the issues they care about. For example, oil companies extract and burn fossil fuels, but they are also heavily invested in renewable energy research and development. Even more dubiously, agricultural companies produce food that feeds the planet and lifts millions of farmers out of poverty, but they may be polluters or engaging in unsustainable environmental practices. Arg. One company may have a strong record of women in leadership positions, but over-index on polluting and carbon emission activities. Come on. Another may have a strong environmental record, but have poor employee management relationships. When vetting an ESG fund or platform, make sure that you understand which issues are most important to the fund manager. If those values align with yours, then the fund or the platform may make sense for you. No clear environmental, social, or governance standards. The Securities and Exchange Commission, SEC, regulates reporting for publicly traded companies. While the SEC requires companies to report certain metrics, its governance of ESG metrics is loose. As a result, every company manages its own ESG reporting. An external agency, International Sustainability Standards Board, ISSB, is slowly working towards setting international environmental standards. But this work is slow. Today, investors must depend on company-defined and reported metrics. In some cases, these may be credible sources of information, but they may gloss over some poor business practices. You either need to trust your fund manager to dig into these metrics for you, or you'll need to spend a lot of time researching individual companies to add to your portfolio. You may become under-diversified. As an ESG investor, you aren't precluded from investing in any sector of the economy, but you run the risk of becoming under-diversified due to your ESG standards. For example, a person who requires a strong track record of women and minorities in leadership positions would find very few large U.S. stocks in their portfolio. If you don't actively seek out energy alternatives, you're likely to miss out on this important sector. Figuring out an appropriate asset allocation becomes very important if you're an ESG investor. Using a portfolio analysis tool may be critical to keeping your portfolio on track. So, does ESG investing make sense for you? Only you can decide whether to include environmental, social, and governance factors in your portfolio. If you decide to use those factors in your portfolio, you need to decide which issues are most important to you and select your portfolio based on those criteria and profitability. Despite the lack of clear guidance on ESG investing, there are hundreds of ESG mutual funds available, and robo-advisors like Betterment and Wealthfront offer ESG options for investors seeking passive options. And if you want to read reviews on some of those robo-advisors, you can check out thecollegeinvestor.com. You can also find portfolio analysis tools and all kinds of really cool resources for you right inside this article. Just copy and paste the title of the podcast in the search bar. Again, it's thecollegeinvestor.com. Follow us on social media. We're everywhere. We'd love to get to know you too. And thanks for stopping by today. We'll talk to you again real soon.